Welcome to the Rose Show podcast. Please visit rosannaprestia.com for more episodes of the Rose Show podcast. Thank you for listening and enjoy the show. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on the Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only. Thank you for joining us today. Get ready for a market reality check. I'm Rosanna, and I'm here with Matt Petrallia, CMT, founder and CEO of Trading Equilibrium. Matt is a technical analyst and super smart trader with over 20 years of experience and a really great guy. His risk management strategies are some of the best I've seen. It is so important to protect yourself and your assets, especially during these volatile times. Matt, how are you today?
I'm good, Rosanna. Thank you for having me on. Excited to talk with you again.
Absolutely. Likewise. So, Matt, please tell us about yourself and your background. We want to know more about Matt.
Sure. So the short story, because I've had a kind of, I guess you'd call it, non-traditional career. I definitely don't have a Wall Street pedigree or anything like that. Trading was something that I got very interested in when I was younger, mainly because I started thinking, hey, one day I'm going to have some money. Let's figure out what to do with it, right? So in college, I kind of started thinking about, how do you really start investing? How do you interact with the market, so that one day I can do that. And over the years, really, I started out really small, like everybody does, started in a completely different career. I was actually an architect, moved into real estate development, but all through those early years, I was, following the markets, beginning to trade, getting my feet wet. And first 5 years or so, 6 years or so, I'd say I made every mistake in the book. And this was pre-YouTube, basically when email was just starting, really. So there was far less real-time resources. Plenty of books, things like that. But I really felt like I was on my own and just kind of making my own way, right? So made a lot of mistakes. I mean, mistakes that I look back on and they seem so obvious to have avoided at this point, but had to make them in my case and learn from them, obviously, right? So I've got plenty of, ammo to sift through in terms of mistakes made and lessons learned. And then over the years, certainly started to refine a real process and make actual headway using, proper risk management and defining a strategy for myself and really getting to know what works for me over time. So I'd say, the past 15, 16 years was really more of a process where I was more in tune with what I was doing versus the first 5 or 6 years where it was trial and error. So self-taught, and along the way, I have gone in and out of full-time trading because, like I said, I've had a separate career. I have, built up separate sources of income. So trading has never been something where it's what I'm doing to pay the electric bill. I have a lot of people ask me about how do you start full-time trading, and I come from a different perspective where I think it's really actually valuable to have another income when you're first starting off, and using trading as a way to build up some extra capital. And then you get to a position where you can make a decision if you're gonna trade full time because you're capitalized enough, right? So for me, I'm at a point where I can have some passive income and I can trade, and that's it's a luxury, I would call it, honestly. After 25 years of working really hard at it, that's where I'm at, right? And a couple of years ago, I started a service just because I started talking to people in my personal life, people that aren't traders, but they knew what I was doing. So they started asking me for advice, and I actually enjoyed it. I enjoyed giving advice about the markets in a realistic way, not like what you see on a lot of big Twitter accounts. And I had a background actually in teaching. I taught some graduate courses at NYU. So it's kind of a natural fit to try to teach. So I started a service a couple of years ago and running with that. So that's the short story. Probably a little longer than it even needed to be, but self-taught is the super Cliff Notes version.
I love that. Self-taught and autodidact. That's wonderful. And you learn from experience,
Right.
And I think that's the most valuable. You have to do it to understand it, and especially in a field like trading, and you learn from those mistakes. That's most important, making the mistakes, but learning from them.
Right.
And that's key. And I think it's great. You've created this reality-based mentality with trading equilibrium. And I'd like to talk about this reality-based trading that you call it. So what does it mean to you, reality-based trading?
So it really means to me that you're functioning in the real world, right? Because I have a kind of love and hate relationship with Twitter, I should say, where I started very early on. I got on really early when Twitter was first created in 2008-ish. And trading was, starting to become a thing on FinTwit. FinTwit was starting to be created. And then I took a 10-year break and just focused on my own trading, right? Because there was a lot of toxicity there, in my opinion. So I really, really value cutting out the noise and cutting out the marketing, the fantasy land that is on Twitter. I really value that. And that was a great time period for me to be more internalized, those 10 years where I was not on social media and just working on my trading and doing my thing. And it just became really clear to me when I came back on Twitter that there's a lot of people that are just not grounded in reality. And I think it causes a lot of harm, mostly to the newer traders that don't have the historical context of having traded for a while to understand what's fantasy and what's not fantasy, right? And it's so easy to buy into a fantasy. So when I'm teaching people, I'm really trying to ground them in reality. And what that really means is grounding yourself in realistic expectations, what you can achieve, being realistic with your time frame. So you want time frame alignment. If you're a swing trader, then you're not sitting there looking at the monthly charts or trying to figure out what's going on. You're trying to read Jerome Powell's mind. I mean, you're trying to focus on what you're doing in your time frame, which is reality based. It's not fantasy land. And you have to adjust your expectations. So when you see, the things on Twitter that are posted of, 1,300% gains in the last month trading options with no experience, people do fall for that, right? And people get, whether or not they actually believe that it's real and actually follow those people, they start to get that mindset of, this is a get rich quick scheme. And my mindset is this is a compounding over a lifetime wealth creating endeavor, business, right? And that's reality based trading. And that's really, that reality is really much more powerful than that fantasy of overnight riches, in my opinion, because it's real. But it requires real effort, real time, a real dedication, an ability to persevere and come back from getting knocked down, and an ability to grind it out and keep going. And you can't expect, just riches to pour into your account overnight simply because you're following some anonymous account on Twitter. So those are some of the things I really try to stress to people that, simple things like I'm a 50% trader in most years, 50% batting average, which means I'm wrong 50% of the time. I get stopped out or stop myself out 50% of the time. And so many new traders think that means you're doing something wrong. And like nothing could be further from the truth, because a lot of people on Twitter will never show losses. They'll only show winners. So I try to show the reality of what this business actually is if you want to take it seriously. So, realistic expectations, a realistic way of operating is what I'm trying to teach people.
I love that. Truth, reality, that's where we need to be. Otherwise, our portfolios suffer. I agree with you. There's a lot of toxicity on Twitter. I also have a love-hate relationship. Yeah, it seems that many just flash the positives, all the good times, but not the other side of it. And it's important to know that making money is hard and it requires effort and time. And you want longevity in the market. You don't want to just have, don't go for those home runs. You want to go. I personally am a small win kind of person, and I'd rather compound and be more consistent with my win rate. And and if it doesn't go my way, cut it quickly. Yep. And move on, and just accept what the reality of the trade is and what's going on. Accountability is very important, and just being very accountable for your actions. And emotions we're human. So we have emotions. What we need to do is minimize the reactions, the impulsiveness from those emotions. Emotions are good. They tell us if we're doing something in line with our values and what we want to do, what's right. So they give us good information. I've spoken to other traders that talk about journaling. Are you much of a journaler? I mean, I'm not, but it helps with writing down trades and ideas. And do you keep track of your trades?
I definitely track my trades in a data point way. I track the numbers and the metrics so that I'm keeping track of the absolute key metrics, because I need to know my R multiples. I need to know my win percentage, because that's the meat and potatoes of whether or not I'm profitable, right? So I definitely track that, but I'm not a journal in the sense of like Dear Diary. I don't sit there and say like, here's what I was feeling. But I do recommend, honestly, for people that are in the beginning stages, if they find themselves getting into these, some people call them tilt moments, where you're just off kilter. You're feeling fear or greed to an extreme level, or revenge trading. I do think it's really valuable to write those things down, if for no other reason than you're consciously becoming aware of it. And you're just making yourself aware of when you're feeling those things, so that the next time it happens, and it always does, and you're like, all right, I'm feeling that way again. Let's not act on it, And then that's a good way to start to counteract those feelings that you're inevitably going to have. But no, I don't sit there every day and write like, I had a ham and cheese sandwich and I was full. And, I don't do that. But I've done this for long enough that I can recognize, all right, I just had 4 losing trades in a row. Let's really try to avoid sizing up and revenge trading. Let's not do that. So I get that. I've done it enough times that I recognize it. But for people that don't necessarily recognize those things, I think it is valuable to actually write them out, because it kind of puts it into the real world, and like you've acknowledged it. And then the next time it shows up, you're like, that's that thing again. I have to avoid that, right? So I think that's valuable.
Absolutely. I like that. No Dear Diaries for Matt and for myself either. But right. Yes, over time with experience, we also can identify when we have a potential to revenge trade. And I'm guilty as well. I could tell when you just get that feeling. And it's about being aware right. of your emotions and, identifying them, so you don't act subconsciously based on those emotions. And, right. You touched upon one of my favorite topics, simplicity. And we talk about that with our charts, but also with our decision making. And I just want to bring up 2 points regarding decision making, because that is an area I focus on. We have bandwidth constraint, and too much noise, and we're just bombarded with information. And with that noise, too much noise, it clouds our judgments. And so we don't tend to make the best decisions. So by simplifying our decision-making processes, we can have more accurate judgments, which the goal is ultimately to have a higher expected value from our choices. And so you mentioned that word in simplicity. What is simplicity to you? How are your charts aligned with that simplicity mindset?
Yeah, it's been an evolution for me, because I'm a person with an academic background. I got 2 master's degrees. I have a tendency to overthink, right? And I'm happy to overthink in certain situations, right? But for me in trading, that doesn't work. It's not about overthinking. It's about spotting an opportunity and executing based on the experience that you have and the simple decision-making process you have in place, right? So for me, it's like I could sit there and see a chart, and then start to question it. I could add 5 indicators and say, well, price looks pretty good, but the MACD looks, is doing X, Y, Z, and then the on balance volume is doing X, Y, Z. So maybe they're going to fight with each other. And I got a CMT, right? So with that absolutely leads me to be able to over intellectualize in the indicator field as well. But going through that process actually made me even more aware that simplicity is better. So what I do is really try to take out the noise out there. I mean, you could sit there and just sit there and hesitate on every single trade. If you're going to say, oh, there's this Fed speaker tomorrow, there's, something, this macro indicator is causing red flags to go up for a lot of people. So maybe I shouldn't enter this swing trade because there's this macro indicator going in the wrong direction. You could come up with 100 different things like that, right? And you could just sit there and never execute, or worse, just execute with 0 confidence, because you're not really following a plan. So what I've done over the years is, I started off with charts where I probably had 3 or 4 indicators, and I would look for the magic indicator. All I have to do is figure this one out, and I'm going to have this whole market thing cracked. In the very early years, also because I'm a visual person, that's the way I really entered the market. And over the years, cut all that out. I'm looking at price and volume. And I'm looking at simple patterns, honestly, and simple behavioral patterns that emerge in price action. Because I can sit there and say, oh, this indicator is doing that. The Fed is saying this, the retail sales came in hot, 10-year yields up. How can this possibly be happening? Whenever you're saying to yourself, how can this possibly be happening? You're probably underwater in your position, right? So I'm just following price, simple as that. So I think that, there's a lot of traders out there historically that have come to the conclusion that price is the ultimate arbiter here. There's many of them. Darvis, Livermore, they've all said price is the be all and end all. Brian Shannon, only price pays. I say you'll lose every single argument you ever have with price. To which people, by the way, always respond on Twitter, you'll lose every single argument you have with your wife. It's like a thing that happens, but that's always the response. But anyway, for me, simplifying is focusing on those key inputs, price and volume. And then that way I can put all the rest of it aside, because that's all just going to be swirling around no matter what. But the thing that I'm interacting with in terms of where my money is going and what's bringing me into a trade is price. So that's where the rubber meets the road for me. So I try to underthink, honestly. And there's a trader, Tom Canfield, that said that his phrase is "be dumb, follow price." And I mean, it make get rid of the over intellectualizing, follow price. And that's absolutely, what I subscribe to.
I love it. You're too smart, Matt. You're way too smart. It's funny that you say that, and only price pays, follow price, and be dumb and follow price. It's actually much simpler. And you're an overthinker just like me. And I think a lot of people overthink and they try to overcomplicate things. And It's actually very simple. Price and volume, I agree completely. That's exactly what I focus on as well. I look at moving averages, and the VWAP is really great, and the anchored one as well. And, it's about the buyers and sellers, and it's about supply and demand. And I think that the volume reflects that. It's ultimately about people. It's, the market's reaction. It's not just, you can look at the numbers from earnings, and then you look at what's going on with the stock, and you're like, wow, there's a big disparity there. Because ultimately it's about the reaction of the people, the buyers and sellers, and not just those numbers in a vacuum.
Right.
So great points that you make there. Herb Simon, the father of the behavioral economist movement, said, "A wealth of information creates a poverty of attention." And I think that's well said. So simplicity is key.
Right.
So I want to go into what you're doing right now in the market. The market has been running. We're right now in February of 23. And what are your thoughts on this market? Obviously following price.
Yeah.
But what are you thinking? What are you seeing with the indexes and the various sectors and stocks?
So overview, I'm definitely never going to fight a trend, right? So when we were clearly trending down, even, on all time frames, short, medium, long, I was looking for short setups. I never get aggressive short, but that's what I was doing. Then comes along January, strong near-term uptrend. I'm not going to fight that. So I did stop doing, my exercise of looking for short setups and taking long setups. And for the month of January, February, that's what I've been doing. That being said, it's still very choppy. And the environment to me is more important than any of these, bull market rally, new bull market calls that get made. Because, and I've tweeted this before, if somebody came from the future and whispered in my ear, the bottom is in SPY, I still have to do exactly what I do. I mean, I think I'd go into my IRA and buy more SPY, right? That'd be the only thing I do. But in terms of trading, I still have to do exactly what I'm going to do, because I'm taking swing trades that you still have to time your entries. You still have to have reasonable risk reward entries. You have to have smart buys. You don't just buy willy nilly and chase, So that knowledge that the SPY bottom may be in, that doesn't mean we can't chop around all over the place. I mean, we're chopping around all over the place right now, right? So I still find it to be a really difficult environment, and I just try to put the macro stuff aside. Of course, I have an opinion, but I try to put the macro stuff aside. So I am taking long trades, but what I'm doing is really focusing. I've had my watch list narrowed down tremendously for all of 2022, and that is still going on. So I really have a small list of stocks that I'm watching that will tweak it here and there, but I have a few stocks that I'm watching. And I get to really know the personality of those stocks and why I'm watching them and what I'm looking for. And then I'll take 1, 2, or 3 trades, honestly, and really focus on them. And I'm sizing smaller. So these are things that are defensive ways of handling a choppy market that I did through all of 2022. And in 2022, not to brag or anything, but a lot of people think that you can't make decent returns if you have a risk first mindset. And that is not true. I mean, I did this strategy where I had 1, 2, 3 trades on. The most I ever had was 4 in 2022, and I had 19% returns. Is that 300% that make people think, oh my God, I'm going to quit my job and I'm going to day trade all day? But the market was down 30%. If you look at the Qs, the SPY was down 20%. So I had positive returns being very defensive and selective in 2022, and I'm sticking with that for now. I don't have the green light at all to start getting aggressive. So for me, I'm smaller position sizing, which means about 25 basis points per trade, meaning 0.25% of my entire account at risk per trade. So if I have 3 of those on, it's less than 1% of my account at risk. And I can still make those returns being that conservative. If the market if the environment changes and I start to see a lot of follow through, a lot of support, a lot of stocks moving higher in aggregate. And yes, we had nice breadth to start the year, but there's still a tremendous amount of intraday volatility. If I start to see that volatility come out and a lot of my own trades finding better traction, then I can ramp that up to 1% per trade and go from there and be aggressive and even incorporate options. But so again, the Cliffs Notes version after talking your ear off is that I am being defensive. I am sizing down, trading small. And I still think this market is treacherous for a lot of different reasons. So while there has been some, obvious near-term strength and some technical strength, it's not the environment I want to get aggressive in.
But it's that mentality that you have that gave you that 19% last year, positive, against the negative 30% of SPX. That's very impressive, Matt. We talk about risk management. We're going to get into that next. But they say, I followed my stop loss, or I followed, my trade went against me. I cut the position and the stock ran 50% and I missed that. Fine. You missed that party, but you save yourself a lot of losses by following your rules. And that is key. It's about limiting the downside. And you've done that very well. So admire you and your approach. That's very impressive for last year.
Consistent, very disciplined. And he was down 2% for 2022. And it was like frustrated. And I'm like, you have no reason to be frustrated. And we went through a bunch of trades and like all the logic was sound. It all made sense. It was all consistent. But the market is the market, right? And it was a very, very choppy environment. And I said to him, the SPY's down 20%. You were down 2%. That is a huge victory in that kind of environment. I mean, for me, honestly, and still right now, 2022 going into now, honestly, has been one of the most difficult times in my entire time of paying attention to markets. So if you were anything but destroyed last year, honestly, you're doing a pretty good job. And that's another thing I like to emphasize as part of reality-based trading. Like if you were anywhere close to break even last year, you're doing a good job. And you have to acknowledge that. And I think a lot of people feel badly even when they're actually doing a good job. So that's one of those things I try to get out to people because it's real. It's a real problem when you're caught up in fantasy land because it can hit your confidence in a way that keeps you from acknowledging and making more progress.
I love that. Thank you so much. We got to not be so hard on ourselves, and we can't feel that we have to revenge and come back this year stronger.
Right.
We come back stronger with a positive mindset and following our rules, staying disciplined, being patient, but not going and taking more risk, because that can lead to the opposite side. So are you swing trading right now, or do you do long-term trading as well? Are you a mix of everything? I know we talked about in the past how our swing trades went from a few months down to just now a few days.
Right.
How are you looking at things for the mid to long term?
Yeah, so I'm a swing trader and a position trader. In a strong trending bull market, I will definitely put on more position trades and try to let swing trades run more because that's how you can actually let your winners run, right? So you have to have the right environment for that axiom to work. In this environment, my swing trades are much shorter term. I mean, sometimes they turn into day trades. I'm not trying to have them turn into day trades, but sometimes I'm just out, right? For whatever reason, whether it's because the gain came really quickly or I stop myself out because I'm being really defensive. I don't enter trades looking to have them be a day trade, but in this environment with the massive intraday reversals we have, sometimes I'm out in a day. So my swing trades have been compressed in terms of duration, probably 3 days on average, honestly, which is short in my opinion, 2-3 days. In a trending bull market, I'll have swing trades around for 7 to 14 days, and then I'll have partials run if possible, into the multiple weeks, multiple months. And then position trading is a different story where, my objective with a position trade is to try to let it run multiple months through some earnings reports and things like that. I have not at all been doing that in 2022 or 2023, simply because the trend has been down. Arguably that may be starting to change, but since January of 2022, the trend has been down. And I don't position trade to the short side. So I'm not going to take a short that I'm going to put on for months. I just don't do that. I'll position trade, only to the long side. I will swing trade to the short side. I don't feel comfortable holding something short for months, because shorting is a very different species, in my opinion. So I'm trading short term right now. I'm not day trading, but sometimes the duration of those swing trades gets so short that it feels a little bit like day trading. And I don't like that way of trading. It's been a tough grind. So that's why I'm keeping really focused on 1, 2, or 3 names. I think I had 4 positions on twice in the past like 13 months. And just to give you context, in 2022, I probably had 12 positions on, at once, and several of them options positions. So granted, 2022 was a runaway bubble. So you got to take that with a grain of salt as well. But in a firm, sustained, uptrend with decent follow through, I'll definitely have on 6% total open risk and 8 to 10 trades. And right now I'm on 1, 2, or 3 trades, real small.
Very nice. Are you long-term with the indexes? Is that correct? Do you invest in SPX, or do you go long-term with any stocks?
So long-term meaning kind of like buy and hold. No, not with individual stocks. I do that in my IRA. I have SPY because I think it makes sense. I'm getting older now, so maybe, it makes even a little more sense to have more in that arena. But, I do believe that, basically averaging into the SPY does make sense if you're a long-term holder, right? If you're sitting here thinking, I'm going to hold this for 20 years, and I'm sort of around that range, maybe a little less than that. But yes, that's the only kind of long-term investment I would say. For me, a position trade will very rarely go into the years in terms of duration. I mean, it's going to be mostly multiple months. And that's about it. Because for me, honestly, even if you find a company, even if you find that needle in a haystack, like Apple, the odds of finding that are so incredibly low. When you think that there's 8,000 stocks on the market, what is going to be the next absolute planet-changing, civilization-changing company, and what you have to go through to actually ride that out. I mean, I just think that, there's so many cognitive things working against you to actually be able to hold a position in a company like that for decades. Right? Unless you just hand it over to a financial advisor and some portion of your account is in that and you're not looking at it. But if you've got a decent position in a stock like that, you have to deal with a major, major roller coaster. And that kind of goes against my way of thinking, because I'll never take big drawdowns, like what Cathie Wood did. I mean, not in a billion years would I take an 80% drawdown ever. I don't care. Like, she's got conviction. She's got all of that, right? She's got the research team. She is convinced, but took an 80% drawdown. And that's why I focus on technicals, because for me, there is no way I'm sitting through an 80% drawdown. And to hold something for that long, you're almost inevitably going to go through a very, very deep drawdown. And that's just not the way I like to operate. And that's one of the things that you have to come to terms with yourself. I'm not the kind of person that's going to sit through 50% drawdowns. I don't even want to sit through a 10% drawdown. I limit my total open risk to 6%. So if everything hits the fan, if there's like a nuclear bomb dropped, God forbid, I'd lose 6%. But I'm never taking an 80% drawdown ever. I mean, I don't care what the story is. I don't care what the fundamentals are. And you can look at a lot of the stocks that go down that much. And I mean, people were touting their fundamentals, all day long, right? In 2020, and then absolute turn on a dime in 2021. And if you weren't paying attention to the technicals, you got stuck in massive drawdown. So again, long story short, the reason I'm not super long-term is because I think to make it really long-term, you have to handle incredible drawdowns. And that's just not something that suits me.
Great thinking. I'm long and I'm midterm, but my long is different than the long out there. I'm not a buy and hold kind of person. I don't think there's I actually just reduced my position in end phase. When end phase went over 300, I cut back significantly, and I bought it in July 2020. That's just an example of when I think of long term. To me, it's a few years, maybe less. Most long term lately, like SMCI, I'm going to mention that one as well. I picked it up last spring, and I reduced my position. I think significantly, maybe like 75% of it is down. I mean, I'm holding about 25% of what my high was. So I'm just right now in this market, I'm in a reduced position sizing mode. So the ones that I'm holding, which long-term to me, as I said, is 6 months, 6 months to a couple years. Those are all reduced. So I have that account that I look at. And then I have my trading account, which is, like you said, the swing trading, which has been reduced now to a few days. I've been if I get the opportunity to get out with a nice little profit, I'm happy.
Yep.
I'm not going to hold on to hope that these winners run, because this past year has been very difficult with that. And then, buying the dip is another axiom we've talked about. And like you said, you're not the type of person who goes in and looks for those. You don't salivate. I love that term you use, right, for those big pullbacks, because we've seen that these pullbacks bring forth more pullbacks. And so I don't want to be in that stage. And so, it's just been a different market, but that's what we love about the market, is that we're always adapting, we're always learning, and it makes it fun. And I'm a very visual person as well. So, I'm curious where you got where'd you get your master's degrees in?
So architecture, master's degree in architecture. So I was an architect for a while. I was a professional master's degree and a master's degree in real estate development. And it was that degree was at NYU, and I ended up teaching some of those courses for that graduate program at NYU. So I can over intellectualize.
Absolutely.
I've been through the academia world enough to like be able to over intellectualize, and I've actually had to work against that, honestly, to get to what I'm doing now. Whereas I think people view following technicals as somehow lowbrow, somehow, there's something inherently kind of barbaric about it, almost like you're not using your brain power, right? It's too simple. It's too simplistic. It can't possibly work. You're not thinking enough. It's not complex enough. But I would really argue that, price is what you are trading. So if you're not following that, you're going to lose every single argument you have with price, right? So when I see certain patterns set up, certain really good entries set up in terms of risk reward, that's what it's all about. Is just, go off on a tangent a little bit. Charting, to me, is not about predicting the future. It's about finding really good risk reward entries. That's what it's all about to me. Finding possibilities there where you have really good risk reward entries. It's not about predicting the future, because you can have a textbook setup that is literally in textbooks all across the publishing world, and it's going to fail. It's going to fail a significant amount of times, right? But you can identify those spots, those moments where you can execute, where you do have a really good low risk entry, meaning, the reward could significantly outpace the risk you're taking. That's what I think the benefit of charts are, right? Not to mention being able to obviously see what trend direction you're in as well. But the general idea is that I'm not overcomplicating everything, and just trying to keep things simple so that I don't overthink everything into the ground. And for me, what works is following some simple price action behaviors, price action signals. And then I take the trade in the right environment, right? And I'll get aggressive in the right environment. And to me, that part of identifying the right environment is so much more important than identifying the setups. Because in 2022, plenty of long setups that just didn't work. Go figure, bear market, right? So you have to know the environment. I know I went off track there, but I have a tendency to do that.
We love when you go off track. You're so brilliant, and you are so smart, and I love what you bring to trading. And yeah, I know that the charts involve a lot of brains actually, and it's very geometric, and it's like a certain way of looking at it and seeing the patterns and understanding those patterns. And it's there are quite a few traders, and they don't like to use the word expert, but I do. I think it's important to distinguish. There's an expertise-based intuitive decision-making that goes on. And what that is when you have these pattern matching, and you can match these patterns against recognizable prototypes in your head. And it just comes from, it's like an implicit, tacit knowledge that you gain from many years of experience of doing something. And you can't really impart that knowledge directly by teaching, but you can do it through mentoring, and people can mimic you, and they can learn, and they can create their own methodology based on that. So you appear to have that, and you see these patterns in the charts, and I love that. Could you share with us? I know we're probably not going to understand because you have it all in your head, but what type of patterns or signals do you pick up on to minimize that risk for the reward, or to get a higher R?
Yeah. So there's one part about pattern trading that I think everybody needs to understand too, is that I think a lot of people get caught up in label trading. I'll call it, like you may call it, you can call a bear market rally, you can call it a new bull market. Those are labels, right? Which don't mean anything until hindsight. It's the same with patterns. Labeling something does not mean the outcome is going to be certain. Right. So there's a lot of people out there that, will say, well, this is a bull flag, so I'm going to get in this because it is going to go to 110, whatever. Like they think that's the certainty. If I can just label this certain thing, it means XYZ will happen. Right. So I just want to clarify that although I trade patterns, you also have to understand that simply by calling something does not mean there's certainty involved, right? So, but what I'm looking for is I'm always looking for range contraction, because the simple philosophy is that range contraction precedes range expansion. And I want to be in on that range expansion. So if a stock is trading real wide and loose, if got real long candles, wide candles all over the place, I'm not going to do anything with that until it settles down. So I'm looking for range contraction, in whatever form that takes. But you can think of the simple things like bull flags, descending wedges. Descending wedges are one of my bread and butter patterns. And it's more about the psychology behind it than just the simple lines that anybody can draw. And yes, over time, especially if you're visual, everybody can start to pick out these simple patterns in a chart, but it's much more about understanding the psychology behind it, and what's happening with the market. If something's pulling back in an orderly manner, it's unlikely that it's forced selling or panic selling. It's, people, you can think about what's behind it and think that if there's orderly pullback taking place, it's usually profit taking, short-term profit taking, and the stock is being still supported by longer term money, the funds that are out there that have the big research teams and that are still accumulating a position, right? If you start to see something really, really tank, and go wild to the downside, it's really loose and disorderly, then you may have some much bigger volume coming in, much less conviction in the longer term holders to hold the stock. So there is a psychology behind all these patterns. So I like to look for kind of orderly pullbacks, that get tighter and tighter. The range on the candles get tighter and tighter. Volume starts to dry up. There's nothing new about this. I mean, tons of people do this. And then you want to get in on it as it starts to move in the right direction. And you're looking for that range expansion. So when the stock gets tighter and tighter and tighter on drying up volume, what you're looking for is volume to come back in and the stock starts moving higher. So really simple as that. And it can come in many different forms. I really like the simple ones, like a descending wedge is one of the most powerful ones for me. It's really something that you can, it's not guaranteed by any stretch of the imagination, but I've done it so many times that I can just I start to understand if this is working the way I want it to be working pretty quickly. And if it's not, I can get out, So I think that there's a lot to be said for just having seen hundreds or thousands of these, because then when it's not doing what you want it to be doing, and you can get out of Dodge, right? And if it starts to behave the way you want it to behave, you can either add or, raise your stop or whatever. But it's really important to have a point in a chart where you feel like this is the opportune time to enter this, to see if this is going to play out based on the hundreds or thousands of these patterns I've seen in the past, So kind of simple as that, but there's tons of patterns out there. I do like simple base breakouts too. Those just have not been working since February of 2021. Basically not every breakout, but so many breakouts just get reversed and sold into. So it's been a market where you really want to take pullback buys, which again is kind of those bull flag descending wedge type buys. And then, I'm more than anything else, I'm looking for that range contraction. If something even comes back to a key moving average and is, pulling back in a way that seems like a constructive pullback because it hasn't lost key moving averages. If it is disorderly, meaning those candles are still really wide, I have no interest. I need the stock to tighten up to give me a good entry. So, because then you can place your stop at a reasonable level. There's obvious levels where, there's so many people that overthink it, I think, because I hear all the time, they're hunting stops. They know where my stop is. It's like, first of all, you're not trading $8 billion, right? Like, you're a normal human. Like, your money is not that material to where the market makers are gonna see things happening, right? You may have 1,000 shares or something like that. The average retail trader is not materially affecting what's going on in the market, right? So I think there's this paranoia that comes in and trying to overthink where you put your stops. But, I'll put my stops below a low of day, below a moving average, below today's low, something, pretty simple like that, where if the price reverses back below that level, then I was wrong for now. I was wrong for now. It may reverse and go higher, but for now I was wrong. And that's just the simplicity that I want, and that's why I never cancel stops. And the stops are the arbiter of if I'm wrong. And it's as simple as that, honestly. So I've worked really, really, really hard to get it to be simple. And it doesn't always work. I got a 50% batting average. It was lower than that in 2022. But I'm, again, very long story short, the key to everything I'm doing is range contraction in strong names. If I'm going long, I want leading stocks in leading sectors and leading industries. That is, I'd be remiss not to bring that up, because that's the whole concept, is that I want to go with the trend, and stocks that are showing real strength when they consolidate, I want to get in on that consolidation. That's the idea.
I love that. There's a sunk cost bias, and I think that stops people from following their stop losses, because they feel like they already put their money in, and you know what, it goes against them. Let me just hold. It's going to come back. It's going to go up, and that causes bigger losses, especially in this market. And I love you dispelling another fantasy world myth about the stop loss raids. They talk about it on Twitter. Oh, the stop losses were raided. Like the money makers just want to come and raid all the retail stop losses and then run the stock back up. So yeah, it's another myth. And I think it's important we follow our own trading plan, and we establish it before we enter the trade, because once we're in the trade, no matter what we want to say, our emotions do affect us. Yep. So I like that idea. I always set up my stops as well when I initiate the trade. I was going to talk about your actual thinking with the trades and your stop losses and the R and all those kind of elements. And I guess it's going to lead us right into risk management. So what is your thinking with risk management? It's a mindset. It's a state. Ultimately, our goal is to protect our principal. We're not in this to lose our principal. So what is your thinking when you initiate those trading plans and the R and all that, please?
Yeah. Again, try to keep it really simple. And the overarching concept here is that you need to protect against losses. That is the main focus. If you have a system a strategy and tactical system, a simple one, like I just mentioned, you're going to have wins. The wins will come. You don't have to protect against the wins. You don't have to try to manufacture wins, right? The wins will happen. But if you don't protect against the downside, you will be out of business. So the focus is to protect against the downside all the time. That's the overarching focus. Make sure that I've got my bases covered in terms of protecting the downside. Because if I don't protect the downside, nobody's going to, and my account will, take big hits. So that's the overarching thinking. It's not just thinking, oh, risk management is just I put a stop in and that's it. I mean, you have to always be thinking, what is the downside here? How do I manage this? So it all feeds into things like I have a way of tracking, and there's no mystery to it, what I call total open risk. And I'm sure a lot of people call it total open risk, meaning if you have 5 trades on, for simple math, and they're each risking 1% of your account, your total open risk is 5%. If you just open those 5 trades that day, right? So at any given moment, if the market goes against you, you lose 5% of your total account. So I'm always tracking that number. If I get it, one of the things that gives me more joy than anything else, quite honestly, is when I can raise my stop to break even on a trade, because then I take that risk off. Granted, something like Credo can happen, which we talked about before we started filming, where you have a gap down that just abominates, any stop loss you could possibly have. And there is such a thing as gap risk, and you have to deal with that by having reasonable position sizing in terms of your account size. But aside from, kind of anomaly events that do happen, I'm guarding against, I'm keeping track of what I have open at any given time so that I know what I can lose, what drawdown I can potentially take. So I'm really monitoring it. There's a lot of people out there, and when I say a lot of people out there, I should caveat that by saying there's a lot of new traders out there, because there's just a lot of misconceptions about things. There's a lot of new traders out there that, think they're managing risk if they're, I've got it nailed down. I'm taking a 0.5% trade, but I have 20 of them on, and they're not, they just don't even do the simple math of understanding, all right, you could lose 10% really fast, and that's the kind of thing you have to keep front and center for me. So every single trade I'm entering, I'm position sizing appropriately, use a simple position sizing calculator based on the environment I'm in. So I'll position size smaller if we're in a choppy environment, position size larger if we're in an environment where my gains are gaining traction. And I will never, ever, ever have my total open risk be over 6%. And it seems very arbitrary, and there's no recipe that came up with that. It's just simply that over time has been a sweet spot where I can still get aggressive. I can still have, larger size trades on, but I will never take a drawdown more than 6%. So for me, it's kind of a sweet spot where I can still get aggressive, but still be conservative enough not to take a big drawdown. So those are the basic metrics I'm thinking of, is the individual trade risk, total open risk, and I'm always guarding against that downside. And I will use, to make the conversation more complicated, we'll use options in the right environment to absolutely nail down that risk. So I use options in specific ways, one of which is to make sure I have, an absolute certainty what my risk is, because options can't go below 0. There is no gap risk in options. They go to 0 and that's it. They don't go to negative, right? So if for instance, I'm trading a really, really volatile name and I'm worried about gap risk, it might make more sense to use options as the vehicle, because I know that I can position size for that to go to 0 and that's it. I don't have to worry about, like, if you were in Credo options, I don't even know what the option trading was like, but if you were in Credo options, they go to 0 and that's it. If you were in the stock and it went down 45%, you took a big, big, big hit. So in some circumstances, I find that options can be used to really, really kind of get a razor's understanding of where your risk is.
Interesting. I'm also an options trader. I guess you're referring to buying long calls. So let's say you bought the calls. To you, then the premium that you spent to buy the long calls are your stop loss, I guess.
Yes. So yes. So I don't do very sophisticated option strategy. I've dabbled in it and found that it was, again, just too much input for me to really be simplified with. So I will use options in certain circumstances. One where a stock is way too volatile for me to stomach the gap risk. One when I'm just simply trying to get aggressive. If, let's say, I have 90% of my account invested, but I want to put on another 2 or 3 positions, you can absolutely leverage options to do that. And another is it just the circumstance I'm talking about, where you can also you can kind of try to get, you can obviously try to get alpha from names that don't have a high beta, right? So you can, like, if you have a slow moving kind of financial name, you can try to get some alpha on that in the right environment by leveraging options. So the two ways of leveraging, and those are the circumstances where I use options. And it's really only in strong trending bull markets that I'll use it. I used to use options frequently to short, because I found it more to my liking that I had that zero stop rather than have like a big bull market run, bear market run where you get, you can find your short position really getting squeezed really fast. I'd rather have that zero stop. But yes, the way I'll trade options is really simple, where I'll buy, long calls and my stop is zero. So I size for that premium. So if I want to risk 25 basis points in my account, I'm buying 25 basis points in my account in options. And I know that they can go no lower than that. So my risk is absolutely super defined.
Yes, absolutely. Do you use options for risk management as well?
I don't really. If you mean hedging, no, I don't. No, because I'm, if I'm short-term trading, I'm just using my standard risk management to get out of it. If I'm longer-term position trading, I'm still not really using options. I think it's a great strategy to use if you're really wanting to hold a position for a long time, because then that is a way to counteract those huge drawdowns I was talking about. But since I don't really do that, I don't feel the need to hedge with options, but definitely can be a viable strategy, obviously.
Yeah, absolutely. And that's what I've been doing with these positions that I've held for 6 months, 6 months or longer.
Right.
And I've been selling covered calls against them, and it
Yep.
worked great last year. And I always say, in a bear market, or let's not give it a label, in a very volatile market, if you time it, you can roll them out a few times, but if you time it, they can expire worthless. So you get to keep that premium. So it's a nice little income, semi-passive income strategy against your shares. I call it collecting rent on your shares.
Yep.
But yeah, you still have to watch it. You have to always watch your account. Like you referenced my husband earlier, if your money's in the market, it's at risk. So you always got to keep a close watch. And that's my opinion, is that the times have changed. The buy and hold isn't really for me during this time period. So got to always keep an eye on it. Yep. And my positions have definitely gotten shorter than they were in the past.
Right.
You mentioned mentoring trades with the plan before and putting your stop in place when you execute. I agree completely. And that has a lot to do with the mother of all biases, which is overconfidence. And that is what we have. And we are overconfident, especially when the trade is activated, that our thesis will be fulfilled. Right. And so I love that magic number 6. I tend to do 7 to 8% because that's just, I give myself a little more room, but I like that magic number 6. So it's very important to stay disciplined and consistent and not change that stop unless it goes up, like you said. And that's a great way to change it up. Yeah, I love that. You change it to where you enter. That's pretty nice. That's a sweet spot. I like that. And then, I want to talk about another bias that occurs with people. It's the anchoring bias. Mm-hmm. And that's really what's happened a lot recently. People are looking at all-time highs, and they look at price targets from analysts, and they say, oh, that's where the price is going to go. So I'm going to hold until I get to that point. And that's when it's a surefire way, in my opinion, of going from any green to red. So those biases are very important to be aware of. And you always say that. I like that you said that earlier. Awareness is key. So identifying and being aware of the biases help us with our decision-making and our plans. You mentioned a really awesome, you tend to personify the stock trading. I love that. I think real traders do that. And you mentioned how your portfolio gives you feedback, and that's your best feedback about how you're doing. Could you tell us how you monitor that and how it talks to you?
Yeah, it's again real simple. None of it is easy, but I try to keep the inputs simple. So for me, after having done this for a while, and I'm taking the same type of trades that I will kind of always take. I'm not I'm not moving from one tactic to the next. I'm not suddenly saying, all right, I'm a day trader that's going to do mean reversion trading, or, I'm not flipping from one tactic and strategy to the next. I'm consistent. So that allows me to really get feedback. But what the feedback is I'm looking for is just trades that are gaining traction. If I have 2 or 3 trades on that are small size, they start to move in the right direction, put another 2 or 3 on. The next 2 or 3 go on. If they're showing, good traction, start sizing up. That's the best feedback I can get. It's not about what are the indices doing, what's the VIX doing, what's the Fed doing. None of that matters, because that's not where the rubber meets the road. Where the rubber meets the road for me is in my account. So if I start to see that I'm gaining traction with the typical strategies that I use, there's no better signal than that to start getting more aggressive, progressively. And inversely, if I'm getting really bad feedback from the market, if I'm getting stopped out left and right, if I'm seeing lots of reversals, if I'm seeing those small trades fail, maybe it's time to go even smaller, but sometimes you'll be chugging along and then all of a sudden things change direction, and that's a really good sign to scale back, as opposed to that revenge trading feeling that people have where, oh, I was doing so well, now I'm taking losses, I may as well size up and make all that money back. That's the exact wrong thing to do for me. So I let that feedback of how my trades are acting and how they're either getting strong traction and follow through and moving as expected, or if they're just reversing and failing a lot. And that's the best feedback I can get. So while there's all these, models that are out there flashing signals for this reason, breadth thrust, up volume, down volume, that's all great, but that doesn't tell me what's going on in my account. I have to know if my trades are working, because I can have all of that in my brain, but is that going to tell me where to put my stop? Is that going to tell me where to enter? Is that going to tell me what position to size to have on? No. What's going to tell me all that stuff is what's happening with the trades I'm taking. So that honestly is what I focus on. I feel like lots of people, feel as if that is, again, lowbrow. Like, this guy can't possibly be really meaning that, but it absolutely is the truth. The best indicator for me is if I'm starting to gain traction, then I put on more trades, get more aggressive.
I love that. Less is more. And progressive exposure. And that's a term that you've used, I use often as well. It's, over time, just having your portfolio give you that feedback, whether to keep moving forward or to retract and pull back. And you do it in a very systematic way, in a very slower manner than, and I respect that. I love that. And it's very carefully planned. The simplicity is key. Alpha. And let's talk about alpha. And let's talk about what it means to you. And there's a topic of durable alpha, and I love that. It's not just about that one trade or the few trades. It's about the longevity. And just like how you said, you were able to be up 19% last year. That's significant, and one of the worst years we've had. I think I've been told by a few traders who've been trading, some of them have been trading for about 35 years. And she told me that last year was probably the toughest market of her career. And she actually said it was worse in 2008. So at least with 2008, we sort of knew what we were getting into. Right. Last year was just,
I would agree with that, honestly, because it's actually much easier, I think, right? Because you can sidestep a big crash. Like, I feel like you can sidestep them. Once you see that the market is having like 4%, 5% down days, in a row, you can pretty easily sidestep that, right? Unless you're trying to swing for the fences and do crazy things. And if the market is trending up higher, great. The hardest environment is the chop, or the constant drip lower, the fake outs. How many times did we see people call a new bull market? Like every green day, new bull market, because of this, because of that, because of this technical indicator, because of this breadth thrust, we're off to the races. Everybody was dying to do that. But the reality is, it's a very tough environment when that's going on, because there's so much indecision and you can get caught in the crossfire. So I think like the COVID crash, pretty easy to sidestep, in my opinion. I mean, you just get out of Dodge, right? And let that one go. Then you had to be convinced to get back in. But yeah, it's been a really, really tough environment, no doubt. It's, in my opinion, it continues to be. I don't care what happened in January. It continues to be a very tough environment.
Absolutely. In this market, how do you look at things? Do you look at just the short term and follow price? are you applying that the risk-free rates are now, we actually shared a tweet about how the 6-month risk-free rate is now over 5%. And I know you simplify and you follow price, but is all that, how are you factoring all that in with everything when you look at trading and going forward? Does it affect you at all?
Well, I'm definitely following price first and foremost. There's never a time where I'm not, because I'm not gonna argue with it. Like home builders been on a tear. Who does that make sense?
No.
But I'm not gonna argue with it. And if you're arguing with it, you're losing lots of money. But I will obviously look at some key things going on. Like if the 10-year yield is continuing to ramp higher, that is obviously going to eventually be a headwind for equities. I mean, there's kind of no way around that, right? Correlations aren't always 100% intact. And like a day like yesterday was weird, right? Because the 10-year yield was up and equities were ramping. And, but eventually you would expect that correlation to come home to roost. So I'm definitely watching things like that. And that's why I was posting that 10-year chart, because I think the 10-year yield and the dollar index are major drivers of the market right now. And the equities market are taking its cues from that. And you have to be aware of those things. And I find it really annoying that we're in that situation right now, but that's the situation we're in, right? And worse than that, honestly, is you can pull up your calendar of which Fed speaker is speaking at what hour of the day. And then intraday, you're going to see big moves. And that's why I think this is still really treacherous, because we're so keyed into these headlines. Anything one of these Fed speakers says is going to move the market one way or the other. And to me, that means that the market is really uncertain. I mean, they're trying to guess what's going on. It's just a bunch of people trying to figure out what is coming next. The same way the Fed is just a bunch of people trying to figure out what's coming next. So to me, the fact that the market can gyrate if one of these Fed speakers opens their mouth so wildly is another indicator of a poor environment. So I'm taking that into consideration as well, but not necessarily because of what they're saying, just because of the environment that's created by what they're saying is why I'm keying on it. Because the fact that can happen means this is not an environment for me to get aggressive in. So that's one of the ways I'll take that input, but I'm not going to sit there and parse every single word each one of those Fed speakers says and try to draw some sort of conclusion from it. Because like I said, I still have to follow price, but it is a big indicator to me that the environment is a very tough environment if we're having those responses to these Fed speakers speaking. And like I said, the 10-year yield and the dollar index are huge ones that I'm following, but mainly because there's an established correlation, and the precious metals have been getting destroyed because they've been very inversely correlated to the dollar. So, I mean, you see those relationships established, and then you're following, how price reacts in both directions. And so I'm definitely keep an eye on those types of correlations, but I'm not forming some big macro thesis, where I'm like, because of this, and this, I think the S&P 500 will be down 35% in the next 6 months, because to me, that's crystal ball territory. And that's largely meaningless for what I'm going to do with my money. It's fun and it's intellectually stimulating, but I've learned enough that intellectually stimulating in the market is not what makes my account grow.
Exactly.
For me.
Yeah, no, I agree completely. We could be, if we want to teach it, we want to be professors, that's one thing. But if we want to actually make money, I think ultimately only price pays. I think Brian Shannon said that. I agree completely with you.
By the way, when Brian Shannon's on, tell him I've been following him for, 12 years now? And he hasn't followed me back. What's up with that?
I will.
He's like one of the first people I found on Twitter.
Have you bought his book yet?
I have. Yeah, absolutely. I bought both of them. I bought the first one a long time ago.
Awesome. Yeah, I love both of them. Yeah. He sent me the recent one. I got a signed copy, so I'm really proud of that. I love it. Yeah. It's a great book, and I can't wait to speak with him. But I'll definitely mention that. Like, what's going on with this? Matt's awesome, and you got to follow him.
No, I remember when he had like 3,000 followers or something, and I was like, wow, that's a lot of followers. This was like, 14, 15 years ago or whatever. And then I took a break, right? And then I came back, and it's like, holy crap, he's got like 120,000 follers now. Yeah. Twitter has changed. So
definitely changed. I'll definitely mention it. I love avoiding labels, and that's key, because with that label, it affects our mindset. Absolutely. And then we're human, we start having these different thinking, and we have biases again, and we say, oh, it's a bear market, it can't possibly be running. So then we stay out of the market and we miss out on some alpha. So let's talk about R and your expectations of R and what's changed in this market. And also please talk about asymmetry.
Sure. Yeah. So they're related, honestly.
Yes.
So when you see somebody on Twitter say, "Oh, I got in on this stock and it's run 20%." Okay. What does that mean though? Where was your stop? Was your stop at 30%? Because that means you're not even at 1R. And R is your risk, right? So that it's the definition of where you entered the stock and where your stop was. That is your R. That's your risk. And then multiples or R is on the long side. So if let's simple math, you buy a stock at 100, your stop is at 99. You have $1 at risk, right? So if the stock goes to 105, that's 5 times R, because your risk was $1 and you made $5. That's 5R. So that's a way of accurately quantifying the progress you've actually made, as opposed to saying, hey, the stock is up 5%. Well, if your stop loss was 1% and the stock is up 5%, you've really made an asymmetric gain there, as opposed to just randomly saying, hey, it moved 5% on me. So I always try to get people to think of everything in those terms. And I'm certainly not the one that created that. Van Tharp is the one that created the R multiple, I believe, or at least popularized it. But it definitely is something that I wholeheartedly think is the way you should look at every single trade. And then asymmetry is just the concept of you're trying to get a higher reward than what you're risking. So you're always trying to get those 3R, 4R, 5R trades. And that's, again, where, optimal entries come in, where you can spot, a potential target, potential runway to a certain area that will take you to 3R, 4R, by placing a stop in an area that, will limit your downside. So it's that asymmetry. You don't want to take a trade where you're risking $2 to potentially make $2, because that, especially if you're a 50% trader, makes no sense. You're at best going to be break even. So you want your winners to outpace your losers. And one of the things I've been doing, adjusting in this market, I think that was part of your question, even though
yes,
I have a tendency to keep going. So what I've done, and this goes back all the way to your first question about journaling. What I did through 2022, and quite honestly, the only reason I was profitable in 2022 was I started to notice when the first couple months, hey, I'm not getting these 3R, 4R moves anymore. These things are reversing real fast on me, so I'll get a quick move to the upside, but it's disappearing. I'm not getting these runners. I'm not getting the let your winners run thing. So I started noticing that really quickly. So it's basic math. If your winners go from averaging 4R or 5R down to 1.5R or 2R, then what do you have to do? The only thing you can control, you can't control where those are going to run. The only thing I can control is the downside. So what I started doing was taking smaller and smaller positions and focusing on 1, 2, or 3 of them. And I was babysitting them, which I don't love to do, but this was how I did it. And I would just cut them. So my average loss was not 1R. My average loss was more like 0.3R. So then that started to make the math make more sense. I had 0.3R losses and 1.5 to 2R wins. So it was by cutting those losers really short and limiting my exposure here and really babysitting them that I made the math work. And I wouldn't have known that if I wasn't keeping a journal going. And that literally is the only reason I was profitable. Because actually my winning percentage on the long side is usually 50%. In 2022, it was 35%. Actually, it was even lower than that, 33%, something like that, which, go figure, bear market. You're going to have the probabilities are against you taking long trades, right? And, eventually I learned that, right? And started trading more to the short side, where I had the 50% win rate on the short side. But tracking those metrics was what was key, and knowing where I stood, where my average winners were running to, allowed me to change my strategy on the stop placement and cut myself out. So that definitely factored into my win rate being lower, because I was cutting them short. So you're going to have a much lower win rate when you're doing that. But it worked, because if you do the simple math, even a 30% win rate, if you've got your winners outpacing your losers by enough, you're going to be profitable. And that, combined with some good short trading, was literally the reason why I was profitable in 2022. There was no magic recipe. It's that basic math. Mark Minervini puts this thing up. I really, really, really respect Mark Minervini as a trader. Not a huge fan of the Lamborghini stuff that he does, but that's all up to him. But as a trader, I think he's phenomenal. And he puts up this meme where he shows his basic strategy is a penny. And he's got, 2 squares where the penny's on heads and the penny's on tails. And the one where it's on head says +2. The one where it's on tail says -1. That's his strategy. He's a 50% trader, but he's going to make twice as much when he wins and lose half as much when he loses. And that's the math. That's the basic math behind all this. Simple as it gets. That's one of the things I always try to focus on. And I was able to go through my numbers and tweak what I needed to do based on what I was seeing happening.
Exactly. Great points. It's about increasing those margins between the wins and losses. And, some people, you're supposed to figure out what your win rate is, and you're supposed to keep track. So you at least know how you're doing. Right. And then you assess with that, how you set up your losses, your stop losses, and how far you let your winners run. Because, in another market, you let them run longer. In this market, you got to be very careful and very cautious. So I think last year was a challenge for many because of having to adapt and change. That you need to increase that margin between the win and the loss, like you said, and you adjusted properly last year, and that's great. And that's the key, is to make adjustments with the changing market, and that's very difficult for many. And that's why a market like 21 or 20, other markets are easier. That was especially easy. But, in general, last year was known as such a difficult market, was because of that choppiness and that going back and forth. And I love this. It's a bull market now. And we bottomed. I mean, I don't know how many times I heard that we bottomed. I mean, yep. Crazy. And we're in a bull market now, right?
No, absolutely. 100%.
100%, right? Everyone's saying it's a new bull market, So, it's just about adjusting, and it really kept us on our toes. Like even right now, I think a lot of people, well, for me, I'm very cautious because of the back and forth. And I feel like any day now, the plug is going to get pulled and we're going to go the other way. So I'm definitely very risk focused right now. Yep. So it's all about risk adjusted returns, and it's not just about what the upside is. You got to think of the downside. So great points. And then absolutely, asymmetry and R are all tied together. Let's talk about mindset, because I believe that mindset is 70 to 80% of the trade, and what is your mindset, and what are your feeling? Look, we're human. And even though you're very rules-based, I admire that. You must have some emotions and feelings. What goes through your mind before the trade, during the trade? And just tell us about your mindset, please.
Yeah, I mean, I think for me, it all goes back to the reality-based concept, right? So I think that, the romanticized vision of being a trader, sitting there with 20 screens and, like the Gordon Gekko. Well, for those of us that remember who Gordon Gekko is from Wall Street, the movie in the 80s, but like the romanticized trading character, that fantasy gets in the way. And like the real nitty gritty of it is like me staring at my trading journal and being like, well, I'm only reaching 1.5 R. So I have to change this, and it's over a series of trades. Right. So I think my mindset is just understanding that this is a probabilities based endeavor. It's not personal. And there is randomness, and you have to be able to withstand that. And I think, going back to kind of points about where your stop losses are, people will see their stop loss get hit, and then the stock runs, and they're like, well, what did I do wrong? Obviously I did something wrong. I don't know where the secret to placing my stop is, because it just hit my stop and ran. It's going to happen. No matter where you put your stop, it's going to happen. It's going to happen to the penny. It's going to happen. There's randomness in the market. People don't want to believe it. So I think part of my mindset is just coming to terms with that. And I think it is a factor of how many years I've been doing it, and you get older too, and you understand that life is like that, right? I mean, there's randomness in life. We don't control 95% of what's going on around us, right? We can only control how we're reacting to it. So that's my mindset, is I can only control how I'm reacting to this. And I focus on the things that I can control, like limiting my losses, taking optimal entries as I see them, trying to respond to what's happening in my account. I can control that. I don't have to sit there and see that I'm taking a bunch of losses and increase my size and lose even more. I can control it. I can stop it. If I posted one thing in during 2022, I said, what if right now in a bear market, you actually focused on not losing money? because like there's so many, even in the midst of a really roaring bear market, you still saw so many people just trying to get aggressive and I got to make 400%. Just what if you actually focused on not losing money right now? Just think about it. My mindset is always grounded in reality, and I think that I focus on what I can control. So when I enter a trade, I'm only focused on what I can control. I'm not sitting here thinking this has to happen or this should absolutely happen. I can't believe this isn't working. It's being manipulated. I'm just focusing on what I can control. I have my stop loss set. I'm watching the trade transpire. I understand that there's no certainty involved whatsoever. So you don't have that expectation of the label trading where it's like, this is a bear flag, so this is going to break down and drop 20%. It's just that understanding of being grounded in reality and focusing on what I can control. That's my main mindset, and couple that with the perseverance to take the lumps, keeping those lumps small as you can, but being able to take the lumps. I mean, that's my focus. My focus is not, I'm going to 3x my account in the next 3 months. That's not my focus. And people that do that often find themselves in a lot more trouble and will take a lot longer to actually learn a way of trading for the long term.
Agree. Thank you so much for that. I think success is about making the mistakes and falling down and being able to pick yourself up and going forward again. You seem to have it down very well, Matt. And we really
Oh, you never do. But I've I can handle
your
risk really
mindset.
well.
I
That's for
admire
sure.
it. I admire your mindset.
Thank you.
Your whole approach to trading is admirable, and risk management is key. And it's a very sexy topic. I know we had this discussion before how it's
least sexy topic in the universe, right? But
it's so
reality.
important. It's reality, and I
Yeah.
think we can all use a little more risk management in our lives. Real trading and investing should be boring.
Yep.
And we love it. We're passionate about it, and we enjoy it. But when it starts getting too exciting, is when we say, what is my risk right now?
Right.
And let me look at my R a little more closely.
Yeah. When your heart is pumping and you feel like that adrenaline rush, probably time to take a look at things a little more clearly, because it shouldn't, you're probably sizing way too big, if that's happening. And you have to be aggressive. I mean, here's the flip side is, while I focus on defense, you have to know the time to get aggressive. Otherwise, you will not achieve that alpha. You will not outpace SPY. But that all comes from this overarching, understanding of the risk that's out there. But once you get things working in your direction, once you start getting traction, you've got to take the chance of opening it up and opening up the throttle and going with it. You've got to step on the gas when you're getting the right signals from your account, because otherwise you're just going to be all defense. So I don't want to make it seem like there's no aggressive trading that goes on, but it's all within the framework of understanding your total open risk and understanding the downside.
Absolutely. I think we have some scars from last year that we're working through right now. So I think maybe some people, and it's okay. It just takes time. So progressive exposure in this type of volatile market. We look at the fundamentals and the risk-free rate, like you said, and the dollar, and we don't let that cloud our judgment, but it definitely keeps us aware of what could happen in the near future. So Thank you so much, Matt, for taking this time to speak with us. Could you please tell everyone how we can stay in touch with you and the services that you provide?
Sure. On Twitter, my name is @TheEquilibrium, which I had since 2008. I thought it was a catchy name at the time, and to me, it really just reflects keeping an even keel. So that's where you can reach me on Twitter. And I have a service that is tradingequilibrium.com. And you can check that out. And that's, where I do exactly what I mentioned at the beginning, where I'm trying to mentor people. This isn't a hand-holding service. This is not an alert service. This is not for people that want to just blindly follow. This is for people that want to learn reality-based trading to be in the market for a lifetime and actually compound returns for a lifetime. Because in my opinion, that's how, the real wealth creation happens. And it's not a get-rich-quick scheme. So you can check that out. If that resonates with you,